Major banks are in focus today as they kick off the start of earnings season. Now, those results, one of many factors weighing on investors as they look to position their portfolio for 2024. Now, our next guest has put out the roadmap highlighting the top 10 themes likely to affect your investment, including central bank policy and political elections. Let's bring in Dirk, Citi Global Head of Macro and Emerging Market Strategy, to discuss more. Thank you for joining us this morning. And so, I want to start, first of all, of course, we had that PPI data. So I want to talk about, I guess they go hand in hand, inflation and delayed easing cycles as they sort of navigate these month-by-month data that's really throwing some people off. Talk about why that made the cut for your must-see report this year.
Yeah, no, thanks very much for having me on your show. It's a very good question. In the end, that's what we are, the single biggest factor will be whether inflation indeed comes off as quickly as the market is expecting, right? Because that will, in the end, allow the Fed to ease, and that will generate the soft landing that the market is gunning for. And we are a bit skeptical just how quickly inflation comes off. And we do think, therefore, that the easing cycle will be slightly more delayed than the markets are currently pricing. And we also think that actually the break-evens, meaning the implied inflation, is a touch too low. And we think those are actually really, you can structure quite attractive trades around that theme. In particular, for the March Fed meeting, the market is pricing very high chance of the start of the easing cycle in March. And you can actually come up with a structure where the only way you lose is if they go with 50 basis points cuts, which I think is quite unlikely because these aggressive easing cycles really only happen when there is a hard landing the Fed is worried about. In a soft landing scenario, you don't tend to go with these very aggressive easing cycles. So Citi believes we start cutting in July, not in March, and therefore they're attractive trades positioning for a delayed cycle, both in the US actually, but also in the UK.
Yeah, Dirk, as you said, inflation has really been the single biggest focus for major central banks, but it sounds like you might start to see a bit of a divergence. Last year was about the central banks really trying to tame inflation by keeping rates high, Bank of Japan put aside. What are we likely to see this year, and how much more of that divergence are we going to see?
Yeah, and Chair Powell clearly wants to generate a soft landing. Right? And therefore, he wants to be proactive and start easing, even with the economic outlook still being relatively strong. And he will be able to do that if inflation really comes off relatively fast. And we do see inflation coming off, of course, at Citi as well, just maybe not as fast as is priced into the break-even market. So that is happening. I think the inflation cycle is also a global cycle, so there won't be that much divergence between the various inflation measures we get across the globe. Again, as you point out, Japan is a little bit different, but we do think inflation will be benign enough that the easing cycles will start. We're just quibbling a little bit with the fact that how early and how aggressive can the central bank be, given that inflation will maybe come off slightly more slowly than what is priced. And so that's why both the delayed easing cycle made it into our top themes, but also the long break-even inflation made it as into the top themes. And I think it's also attractive from a portfolio hedging perspective because the market fully bought into the soft landing, and indeed right now a lot of indications point to a soft landing. But if that were not to pan out, then the main reason would be that inflation, especially ex-goods and ex-housing, is slightly stickier. So that would protect your portfolio as well.
And as you know, market not really managing its inflation expectations here, as we saw from that JP Morgan report, still expecting 6 rate cuts to come this year. So then as we're in the thick of earnings season, broadening EPS was also on that list there. What is the play here strategy-wise then?
Yeah, for us, it means a broadening out from this heavy reliance on the large cap growth sector in the US. And we expect it to branch out actually in 2 dimensions. One is that cyclicals will do well in the US, and cyclicals will meaningfully outperform defensives. And it's not a negative call on the large cap tech names. It's just to get to our 5,100 target for the S&P, you cannot only rely on the large caps. You do need basically the cyclicals to punch as well, and that's what we're expecting for this year. So it's the industrials that will do well and so forth. But the broadening out theme should also happen in a geographic context, right? So again, the fact that the US was so strong, driven by these large cap tech names, means that this year we can also see Europe doing really quite well, which also has a strong cyclical band, and we like to pair that against the UK. So our trades are cyclicals against defensives in the US, and we would pair long Europe against the UK more globally.
Dirk, one of the other investment themes you highlight is Chinese stimulus. It was just a year ago we were talking about a potential big bounce back coming from a very zero COVID policy. That hasn't necessarily materialized. Are you talking about monetary stimulus, fiscal stimulus, and more importantly, how big of a bounce back is that likely to lead to?
Yeah, for us, the trade in China is more a fixed income trade than an equity trade. So we do expect more stimulus, and we think it shifts from the fiscal that has been announced earlier to the monetary. So we do expect interest rate cuts. We do expect RRR cuts. We've seen already big liquidity injections, and that means to us that Chinese bonds are going to do well. And we actually positioned at the front end of the Chinese curve. And that is maybe our biggest China position, if you like. On the equity market, it's noteworthy how poorly traded, even in the light of the additional stimulus. So basically, the private sector is finding it very hard to get its mojo back. And that is not too surprising, of course, given the extent of the real estate bust that we have witnessed in China. So at this stage, we are more confident that there will be more stimulus on the monetary side, which you could benefit from in the Chinese fixed income market, rather than necessarily positioning for the stimulus being sufficient to get Chinese equities to move again. Because even in the US, I think we learned how long it can take and how hard it is to get the consumer and maybe the corporates out of their funk after a big housing bust. And in China, it's not different, maybe even worse, because the policymakers are less aggressive than they were in the US. And so we position for more stimulus, but we don't position necessarily for more stimulus driving the equities higher, at least not yet.
Dirk Willer, Citi Global Head of Macro and Emerging Market Strategy. Appreciate some of those takeaways. Certainly interesting report there. Thank you.